Hello, everyone. This is a talk on finance for techies. And let me share my slide here. So I grew up as a technologist and ended up learning a little bit about finance running businesses. So I thought it might be helpful for you as technologists on learning how our C-suite thinks. So this is a quick crash course on how Satya and Amy think. And from first principles, of course, dramatically simplified. But if you use this framework, you can pretty much understand broadly the kind of decisions that our C-suite makes and ultimately, hopefully, prepares you for future C-suite roles. I hope I'll convince you that this is some of the principles are simple and fairly straightforward, but I'd like to explain things from first principles and sort of demystify a lot of terms that are around here and also understand a little bit of how this affects our day-to-day life and what we end up doing in terms of choices, whether it's strategic choices or project choices and so on. Okay. So this one slide is a takeaway message, right? So Satya and Amy are fundamentally doing two things for our companies, right? So one is for our shareholders, most specifically, is being efficient with the capital that our shareholders have entrusted to them as as the agents of that capital, how to be efficient of that capital. And what that means is how to take that capital and earn a return on that capital that is better than alternate sources of return that our shareholders could possibly earn, right? So so that alternate sources or opportunity cost is called cost of capital, and it's also a measure of the risk of the business. And so if our returns are better than cost of capital, that's job number one done. Okay, be efficient is the first task of the CEO. The second task of the CEO, CFO, and the C-suite is to grow, right? If you are efficient, then and only then grow, right? So the idea is that if you're less efficient, you got to return money to the capital to the shareholders so that they sort of can invest it elsewhere. And if you can grow, that is, if you are efficient and you have opportunities to grow, you can allocate more of the excess returns that you've gotten into future growth. Okay. So like, for example, when Satya made a decision to invest in OpenAI, that's a new growth vector for Microsoft, right? So this is an example of capital allocation, right? So but the principle of capital allocation is if you're efficient, then grow. If you're not efficient, then degrow. In other words, don't grow. And if you're not able to find enough opportunities for allocating capital at a rate of return that is higher than cost of capital, then give back excess capital to shareholders. And of course, balancing for risk and so on, right? And liquidity and things like that. Okay, so that's the basic idea. And it all comes from a very simple idea in finance. And the idea is that of exponent, that is exponential growth. So if I have a principal P and I'm growing at a rate G, okay, for a period of time T, okay, so I have my principal then grows at the total future corpus that I will have is P times e to the power of G times T, right? And that G, which is the growth rate, is actually upper bounded by the return on capital. Okay, one of the fundamental principles of finance is that your efficiency bounds your growth rate, okay? And your efficiency and growth are locked at the hip, okay? You can only grow if you're efficient, and your maximum growth rate is a function of your efficiency. Okay? So these are the short lessons. If there's everything, you forget everything I tell you, this is this picture I want you to keep in mind. Okay, so let's sort of unpack this step by step on Satya and Amy's primary job, capital efficiency and capital allocation. So, we saw this entire business of Microsoft or any business, right, as an engine where you got capital in and you got returns out, right? So, so if you unpack that, you can see that your capital actually goes into assets, and then from those assets you generate sales. okay, and sales or revenue. And from those sales or revenue, you generate income or cash flows. And that is ultimately what goes to the providers of capital. Okay, but remember the providers of capital could be debt or equity type of capital, but this returns or cash flows have to be divided amongst those sorts of capital. Okay, so so this phase of converting your capital to assets, to sales, to income, that cycle, right, or one part of that cycle is called return on invested capital. So on the end of this pipeline, you get operating profit or cash flows. You take that in the numerator, and then you divide that by the amount of capital, base of capital that you invested, or invested capital, it's called. And that ratio is called the return on invested capital. So that's one of the measures. There are several other measures of return on invested capital. Okay, so when you have decided which bets to place, and then you're running those bets or operating those bets efficiently, that phase is called return on invested capital. Okay, once you do that, so you have actually created an engine that is churning out, above average returns, better than the cost of capital. Then what you can do is you're getting this excess income out. You can potentially reinvest that. Okay, and reinvesting that is in form of growing. Okay, in other words, I had $1 of capital. Now I have say $1.2, $1.3 of capital out. Now I can put that extra 0.3. So I had again $1.3 I can pump it in, right? So then if I keep cycling through, you achieve that compounding effect. Okay, now it is good for you to compare this with how you would have invested in a risk-free asset, such as a fixed deposit in India or a treasury bill in the United States, right? So you give your money to the government, and the government gives you a rate of return. Okay, now the government doesn't default, your principal is not going to get lost, and so that's called risk-free. Similarly, if you give your money to a bank, and the bank can give you set an interest, and that's that interest that you get. You can take a ratio of that interest to the capital, and that you put in, and that's your rate of return, right? So similarly, you can say, hey, instead of giving it to the bank or to the government, suppose I give it to Satya and Amy, what is the return that they churn out? Okay, so that's the measure on return on capital, or sometimes called return on invested capital. Okay, so if very simply speaking, if Satya and Amy can give you a better return, then rather than putting your money in risk-free instruments, you would give your money to Satya and Amy, right? So I think that's the basic idea, right? Now, of course, it's a bit more nuanced than that. And now, if you give your money to the bank, at the bank, you have a multi-year deposit, right, like 4-year or 5-year deposit. So the bank then reinvests it in other sources and then gives you back your interest, right? Similarly, Satya and Amy can reinvest your capital over and over again. That's called a capital allocation decision. And then part of that they can return back as dividends as well, or buybacks of Microsoft shares. Okay, so net, ultimately you're looking at what is the income per share, okay, or income per outstanding or diluted shares. Okay, so that's the basic framework, and it's all related to the idea of exponential growth. In fact, historically, the exponent E itself came as as an outcome of how you can sort of have a rate of return, and you continuously compound that, right? If you take a return and put it over a year versus if you do a monthly return versus a day-by-day return, ultimately an infinitesimal set of compounding, and that limit is actually E. Okay, so E actually sort of converts something like, which is a discrete rate of return or discrete compounding, into more of a continuous compounding. So think of it as if you allow your money to grow in a compound interest fashion at a rate G for a time T, your future corpus, if you put in a principal P, your future corpus will be P times e to the power of GT. Okay, so the interesting question is this actually, there are 3 parts here, right? First, you should allow your money to compound, that is go over and over again. Okay, that's number 1. Which means you need this dynamic of reinvesting and return and doing it over and over again. And the second is, each time you run that cycle, you should be efficient. In other words, you get a good return. That return is G, right? See, because 1 year, if you get a high return, another year you get a negative return, then your net return will be lower, right? So this G is actually what is your sustained rate of return over that longer period of time, right? And that sustained rate of return is ultimately dependent upon your efficiency of that engine that you have, which is return on capital. Okay, so so that G is nothing but what is the rate of return that your engine can give you, and you compound that over time T. So this is something that Bill Gates said a long time back. People overestimate what they can do in 1 year and underestimate what you can do in 10 years, because compounding has this huge upslope, which is very hard to grasp intuitively. So if you just do nothing and allow the money to just compound over and over again at a reasonable or a high rate of return, then your money can compound very fast, over a long period of time. For example, if you have a 15% rate of return, your over 30 years, it can become 65 times. 1 million becomes 65 million. Okay, whereas if you take the same 1 million and rather than 15%, you do it at 26%. Now this looks like, hey, there's only 10% difference. So what difference will it make? But your 1 million now becomes 1 billion. Okay, so rather than 65 million, it is 1,000 million, right? So there's a huge difference over a very long period of time. Okay, at a higher rate of return. So each extra percentage point of CAGR or rate of return can cause wonders in terms of your accumulated capital. So the important thing is that you have to invest as an investor. You're looking at this as investing for the long run. And as an agent of the investor, such as Satya and Amy, you're figuring out how to ensure that you keep this engine going on and on. So Satya has to find new places to put this capital in. Such as OpenAI or the cloud pivot and so on, larger target addressable markets. And each time we go after it, we have to do it efficiently over a cycle because things don't happen immediately or in an annual period of time. Like the cloud transformation took more than a decade and it's still ongoing. So so over that cycle you get some idea of what your average rate of return is, right? So similarly, we are now starting a new cycle or a new S curve. Every cycle sort of ultimately saturates. So the job of a CEO and the management team, executive management team, is to ultimately find new sources of growth or new sources where they can start putting the excess cash flow and allocating it. So that's why one of the important aspects of executive management team is not just to operate well, that is have good return on capital, but also to allocate the excess cash flows that is coming out to various projects so that you catch these new growth curves and not just be complacent. Because ultimately, from an investor standpoint, they want to just sit back, they give this money to you as an agent, and they expect you to figure this out. And of course, you get compensated for that. And ultimately, they expect the money to grow, right? So that's the basic idea here. So as I summarized, principal, let's say retirees or pension funds, school teachers, firefighters, normal citizens who are investing and giving a portion of their capital, okay, as part of a diversified portfolio or through an ETF or whichever channel to Amy and Satya, who are the agents, and we all, as Microsoft employee, are the agents of these principles. And our job, our primary role is to serve the shareholders and deliver them a return. So that's why it's very important as and since a part of our compensation also comes as Microsoft stock, restricted stock units, we ourselves are also part of the principal. So the principal and agent are aligned in terms of your expectations, and therefore we are trying to be efficient about going about our business and delivering a cycle of taking capital and giving good operating income, right? So as Amy and Satya report every quarter or every year, we talk about, hey, what is the operating income that came? What is the return on capital? How much free cash flows did you put out for the capital that you gave me, right? Or the capital that is invested in this business, okay? So a simple way to look at it is, Satya and Amy are great people, but end of the day, I trust the U.S. government more than I trust these folks. So, when you're an investor, you would look at, hey, what is the risk-free rate I would have gotten by investing in a short-term or a long-term treasury bill or a treasury bond. And then instead of doing that, if I have to allocate my capital to Satya and Amy, what return should I expect, right? And the answer to that, is given by a model that says, hey, you should get at least your risk-free rate, and you should get a risk premium for investing in this risky business, right? So this risky business, obviously, there's a question of how much is the risk, how much is the risk premium one should charge, right? And this is a fundamental idea in finance, but the answer to that is an empirical one, right? Over time, the risk-free rate can go up or down depending upon how the Federal Reserve sets the interest rates. Right now, the Federal Reserve has been a hiking cycle, so they have yanked up the risk-free rate. So that means that hey, I get paid a lot more by just giving my money to Uncle Sam than giving it to any business, right? So that risk-free rate goes up. And the other interesting thing is that the risk premium also skyrockets or suddenly shoots up in the context of a recession or a downturn. Therefore, the cost of capital that a company faces during a downturn tends to be suddenly inflated up more. Okay, and therefore I have to deliver a higher rate of return, much higher rate of return. And then when this balloon deflates, in other words, inflation goes away, and then you are getting into a little bit more of a normal operating regime. So at that point, your risk-free rate can come down to be more aligned to the real inflation rates, and then on top of that, you have a risk premium, and that risk premium can also come down. So the risk premium is two parts. One is the overall risk premium of the entire market, and then the additional risk premium that has to be charged because of the extra riskiness of the Microsoft's business in particular, right? So so that whole thing is modeled in finance empirically through an idea called capital asset pricing model, which comes up at the end of the day with the price of risk. Okay, and this you can think of it risk as something of two types, right? One is hey, I gave you my capital, and then suddenly I have a permanent loss of capital. So my principal suddenly has gotten impaired. Okay, so that's one kind of risk. The other is that hey, I didn't have a permanent loss of capital. I can have a volatility around my principal. So I give you some money and then say hey, that tomorrow suddenly the stock market has gone down a bit, or maybe after a month it's gone down even more, and after a year it's gone down even more, right? But then you don't expect it to stay down there over time. As the economy is cyclical, the economy comes back. Therefore, you think of this as volatility over a very long period of time, 10, 20, 30 years. It's you sort of just the volatility looks like small amount of noise, but then you have a broad trend of growth, right? So ultimately, if a company goes bankrupt or something like that, those things are permanent loss of capital. Or if some particular business you put a lot of money in and the whole thing is trash, you have a big impairment of capital, right? So those are the kinds of risk. And end of the day, what happens is you sort of bundle all these forms of risk and you come up with one measure called the cost of capital. This is imperfect, but this is a working way in which Wall Street evaluates companies. Okay, so fundamentally, if you take this business and say I put capital in, I get income of profits out, and then I can take the right-hand side of the numerator and put the left-hand side of the denominator, capital the denominator and income or profits at the numerator, and then this measure is called return, right? Return on capital. So you can have different flavors of this. One idea is called return on invested capital. That is, you take the capital, which is the debt and equity capital, and then subtract out the part that is not invested in the business. That is, you're holding as cash, right? So you net out cash and say that is the invested capital as the denominator. So your denominator has actually gone down a bit. And then your numerator is your operating cash flow, right? So and it's typically post-tax operating income, this EBIT times 1 minus tax rate. That's what it is. Similarly, you can have a return on equity, which is on the denominator, your capital is the equity part of your capital. And then on the numerator is the net income, which is the cash flow coming to the equity shareholders. And we'll see the difference between equity and debt when we look at balance sheet briefly later. There are other similar ideas are called return on assets, return on capital employed, and so on. I'll not go into details of this. You can take a look at, you can pause this and just go through the slides if you'd like. Right, but the basic idea is sometimes folks tend to misinterpret return on capital with profitability. The word profitability means if I give you $1 of revenue, what is the amount of profits that I can get out, right? You can also think of these as margins, the net profit margin, the operating profit margin, the free cash flow margin. So you have a denominator of revenue and a numerator of profits. Okay, whereas return on capital is the numerator is profits and the denominator is not revenue. The denominator is actually capital or assets that have been plowed into the business. So what is important to recognize is that there's actually a missing step. You take capital or assets and then get revenue out of them. And then from revenue, you get profit. So there's a two-stage model where you first have capital to sales and then sales to profits. So typically when people misunderstand and say profitability, they talk primarily only about the second stage and they forgot the first stage. And this two-stage model is sometimes called the DuPont formula or the DuPont decomposition of the idea of return on capital. So in fact, many interesting business models are designed how efficient you can take your capital and then convert it to sales. And even the capital, there are two types of capital. One is called short-term or working capital, and then the other is long-term or fixed capital or intangible assets that are there for the long term, like brand or software assets and things like that. Okay, so and how your working capital converts to revenue, or how your fixed assets convert to revenue. Suppose I have a factory, how many cars do I make? Let's say if you're a Tesla versus a Volkswagen, right? So that's an example of once you have put a factory in place, how many cars do I churn out? That's an example of how many, and then what is the revenue that it leads to? It's an idea of how do I convert my fixed capital into revenue. Whereas if I'm Walmart or say Amazon, e-commerce business, I'm interested in saying, hey, how do I take my inventory and the advances that my customers have given me, or the payables I owe to my suppliers, or the other receivables I'm expecting from my customers, and all of that bundled together becomes something called working capital. Primarily, a simple way to think about it is inventories, right? If I stock up a lot of inventory in my warehouses or in my retail shops, and then and then I get the same amount of sales, right? So the conversion of all my working or short-term capital to sales, that is one example of the efficiency of converting capital to sales. So an interesting way in which Walmart and Amazon run compared to some of the other retailers who may be less efficient is they are very, very efficient with their working capital. So sometimes when you manage a business, you have bigger levers in trying to compress your working capital that you need to generate the same dollar of revenue. So typically that is hidden because people often focus on what's called the income statement or a P&L or a profit and loss statement and focus on how the revenue converts to profits. But there's a hidden story between how your assets, especially working capital and your fixed capital, convert to revenue. Okay, so that's something to keep in mind. So that overall, when we talk about efficiency, ultimately I, as an investor, I'm interested in your total return, how you take my capital, convert it to revenue, and then convert to sales. Okay, so that's the basic idea. So the next idea is the idea of discounting and risk. Okay, so if I did not have risk, I would have taken my capital and I grow at a rate G, and let's say it's a 15% CAGR or something like that, and my capital is compounding, right? But the idea is that in the future, my dollars are worth less. That's because of inflation, or there is additional risk attached to things. So I attach a risk rate to it. So think of that as a negative exponential that I attach to my future cash flows. So that you can think of that as an exponential, but it's going in the other direction, right? And your growth should be more than than the discounting that is happening because of your risk, right? Only then your capital net of this risk, that is G minus R, that net growth, right, will be positive, right? So when you look at it as an economic experiment, rather than if I consider all the options of giving you my capital, I've given my capital to you, I'm charging you that risk or cost of capital, and I net it out, and that is called a risk-adjusted rate of growth over many periods of time, and that is called an economic rate of return. And the term G minus R is sometimes also called economic value added if you multiply it by some amount of capital. Okay? So the idea is that if you want to consistently compound, you want to grow when G minus R is positive. Right. So one obvious observation here is if G minus R is negative, you're actually destroying capital from an economic sense, and you should stop doing that. Right. So you should not grow when your efficiency, in this case G, is less than your risk When your efficiency or your returns are greater than risk, and only then you should grow. So that's one of the messages. And also this relates to how your future cash flows are getting discounted. So there's compounding, there's discounting, and then discounting is related, the rate of discounting is related to the risk or cost of capital. And the rate of compounding is dependent on your efficiency and the rate, therefore, of natural rate of growth. Okay, so now typically when you have a bunch of a sequence of cash flows, you take you have a growth rate either growing for a fixed period of time or ultimately in perpetuity, which is over infinite periods of time, and then you discount it with a risk over time. So the idea is that for some periods of time you would be growing very fast, and ultimately later your growth rate either falls below the discount rate or it sort of tapers off or becomes equal to the discount rate, right? So the idea is that if you take your discounted cash flows over these periods of time, you can put it together, and you can see there's a first half where it's called a competitive advantage period, CAP, competitive advantage period. So where you're actually having a competitive advantage over the rest of the market because of cost, because of how you made your strategic choices. And then during that period, you have a fixed period of time, also an annuity where you're growing, and then later a perpetuity where over for infinite period of time or ultimately some long period of time, it stops, and that is called a terminal value. So ultimately, in a discounted cash flow valuation, you take all of this together and sum it up and then see, hey, what is the value? And that is considered to be the value of your company. Okay, so there are a few terms in this, but the basic idea is that the terminal value, as you can see, the light blue bars on the left, tends to actually dominate your valuation. Okay, in fact, especially for a growth company like Microsoft is considered to be a mid-range growth company, or for Tesla or somebody like that, it's considered to be a high growth company. In fact, a lot of its value is embedded, not even in today's cash flows, but over not even in 1 year or 2 years cash flows, but over the long term, right? In fact, so if the market feels that you have a future and your future is good, and your future is growing and you're going to generate a bucket load of cash into the future, and in spite of all the discounting it applies, that number can be quite a large number. So that's called a terminal value. So discounted cash flows, terminal value, the idea of an annuity and perpetuity. Okay, so net, I think you can think of risk as this two-faced god Janus. On one hand, you have this Roman god Janus. You have risk on one side, which is the cost of capital, and return on the other side, which is measured by efficiency or return on capital. So we talked about risk or cost of capital, which is a price of risk. Theoretically, it is a risk-free rate plus some return risk-free premium that is market determined. Okay, and I won't get into the details. Capital asset pricing model says that, hey, you got to add a risk premium based on the volatility or some risk measure of your instrument related to the market. And you got to add that as a risk premium. And therefore, that ultimately says what is the cost of capital for Microsoft, which Satya and Amy have to beat as a hurdle rate when they actually make investments. So net, the summary of this whole part is that if your return is better than risk, then you are creating economic value, then you have the license to grow. And return is a measure of efficiency or productivity of capital. And then ultimately, if you keep doing this over and over again, your future sort of corpus is actually e to the power of G, in this case, return on capital times over the period of time. If you just want to look at the economic value added, you have to subtract or give it a charge of risk. So you do ROC minus R, which is that economic value added times T, and then you put that in the exponent. So now you can see some of if you just look at the simple formula, it tells you some very interesting things, right? One is P has a linear effect on F. That is, if I invest a lot more now, okay, it has a linear effect on what F is going to be in the future. But ROC has an exponential effect, right? Return on capital has an exponential effect because it determines the ultimate growth rate. And in other words, if a company is efficient, that has an exponential effect on the value or the valuation of the company. Similarly, the whole corpus, if you stay invested for the long term, T is very long. T is 30 years as opposed to T is equal to 1 year. your corpus grows very, very big in 30 years as opposed to 1 year. So that's why they say when you're investing, you want to invest for the long term. When you're a kid, you want to put more money, you want to take a bit more risk, but then ultimately your goal is to discover those high returns and or expose your capital to more returns. So that way that turbocharges your overall return portfolio. Okay, a corpus, how it compounds over time. So the important thing is to stay invested for the long term and stay exposed to engines of growth or the Satyas and Amis who can actually convert and deliver day in and day out or year in and year out high return on capital, which goes into the exponent and ultimately turbocharges your portfolio, right? So that's the basic idea. Your maximum capital allocation is therefore P times e to the power of ROCT. Okay, so again, I'm re-emphasizing a few things because this ultimately leads and sort of is imbued in all the decisions executives make in Microsoft or elsewhere. Okay, so the idea is that ultimately capital and the efficiency of capital, how you get to returns is very important, and that's a measure of productivity. And once you have efficiency, you want to reinvest, right? If so, the first thing they ask is, are you operating your business well? That is, are you efficient and taking capital in and coming out with returns? Is that good? That's great. And if so, then hey, find opportunities for growing and please allocate my capital to these growth engines, right? So that way I can compound my capital at a faster and faster rate. If so, then the market will allocate more and more capital towards this, or in other words, it will essentially give Microsoft a high valuation, right? That's the basic idea. Now you can look at it or unpack this in different forms, right? How do I efficiency and how do I capture a customer? In other words, how do I acquire a customer? How do I deliver good customer value versus the next substitute? That's one idea of efficiency in customer value. You can have efficiency in capital formation. That is, how do I allocate to capex and working capital? How do I build my factories efficiently, or how do I develop my software efficiently? Then how do I handle my working capital, my inventories and other things efficiently, so that way I have lesser and lesser working capital that I need to allocate. And then how do I convert all these capital to sales? And then that talks about the economies of scale that we get, how my go-to-market scales, and these. So this economies of scale can come both in the product development as well as in the go-to-market and in the sales side as well. And then once you have sales, how does that convert to profits? What is my cost of goods? And that's called profitability. And then what is the operating profits versus the gross profits? And then once I have those operating profits, how much do I need to reinvest into working capital? And then what is my cash flow after that reinvestment, right? So that's called cash flow from operations. It's where you subtract out working capital. And then if you further subtract out the incremental allocation to fixed capital, that's called free cash flows, right? So there are different terms here, but ultimately all of these are very simple, where it says you have a stock of capital, you get to sales, um, and there's a magic that happens to getting to sales. And then once you have the sales, there's a magic that happens in terms of getting to profits. And then once you have the profits, you have to then incrementally reallocate to working in fixed capital, and then you get your cash flows. Okay, that's a basic idea. And then you can do all these measures, these ratios and so on. And then if the ratios turn out to be good, yay, thumbs up, then you can allocate more and then get this compounding engine going, right? So ultimately you make money only when you compound over a long period. Even if you have 1 year that where your returns are extremely good, that may not be enough. You need to keep compounding over time, right? So the compounding you get over a long period of time is far more important than a flash in the pan. 1 good year, 1 bad year. So this is another way of looking at this. The key rules of finance is first, be efficient in our household. Hey, I have some income and then I have a bunch of expenses, then you save, right? So in a corporate environment, what you get in the door is called revenue, and then you have expenses, and then the savings is profits. Sometimes profits is given a bad rap and so on, but ultimately profits is nothing but corporate savings, right? So when you at your household, you think that if you save, you're efficient, but somehow when it's a corporate, you think that there's some fishy stuff going on, or you're giving a raw deal to some of your stakeholders, right? But if you have a good sort of setup in terms of the market and the rules and legal frameworks, and everybody's being fairly treated, then so ultimately, if you're dealing as an agent on behalf of the shareholders, you want to be efficient, right? So that's the basic idea. And as I also mentioned here, if you're not yet efficient, do not rush to grow. So one of the big mistakes that often is done is for whatever reason you want to, there's a rush to growth, or you think that growth is somehow magical, and you want to somehow do that. But the basic idea is you first want to create an engine that is efficient, and only then you want to grow, right? So if the engine is not yet fine-tuned for efficiency, or it's getting to the right place, if you try growing too fast, essentially you're compounding your money and consuming a lot more capital than needs to be, right? So the idea is that each turn or of that crank of that engine for every year and so on, you will be turning out less returns, and therefore you will not have enough money to actually reinvest. And if you want to grow at a faster rate, you have to go to the external capital markets and please ask them for some more money. With a begging bowl, you have to go for more capital, right? So the idea is that the more efficient you are, the more self-funded you are, right? You don't need to go out and raise external capital, whether it's debt or equity capital. Okay. But the interesting paradox is that investors love those companies which are efficient. In fact, they want to allocate a lot more money to the entities that are efficient. And the interesting paradox is if you're self-funding, you don't need that capital, right? The more I don't need your capital, there'll be more rush for that capital. And that will reflect in the secondary markets where the share prices shoot up. Okay, that's the basic idea. And reinvestment and compounding are one and the same. Efficiency and its effect on growth is one and the same. Okay, this is one of the most important aspects in finance. People think that you can grow without being efficient, but that is fundamentally not true. If you grow without being efficient, you will keep needing more and more capital. In other words, that's what they call it, a capital burning, how fast you're burning my capital, especially if you're a startup, right? Now, there are some basic ideas of industry cost structure and so on. In strategy, there are many frameworks like Porter's 5 Forces framework and so on. But I will sort of give you a very simple idea here. When you have multiple participants in a market who are serving a bunch of customers, different players, like you have company A, B, C, D, E, F, G, H, they have different cost structures, right? So this stacking up of the lowest cost player to the higher cost player is called a supply curve. Okay. And ultimately, what happens is the market price is actually set by the marginal player, in this case, F, which is setting the price relative to the market demand. So if there is more market demand and A is not able to meet all the market, so first dibs are given to A because that company is the most efficient, and then you have B, C, D, and so on, right? So A is making a great profit margin because the market price relative to their cost, right? Market price in this case is about 13 or 14. The A's cost is less than 5, let's say 4. Okay, so you have a fairly high margin here. Okay, but unfortunately, A is not able to expand, right? So A has a great incentive to expand and capture more of the market, or this is called a market share. And then in the process, they will push F out. But as A gets more market share, actually the price drops and suddenly the margins of A also will drop. Okay, because the interesting paradox in markets is that you want to scale, but in the process of scaling, you still want to keep some of the marginal players in the market because they will set the price. So because your margins are going to be somewhat as a function of these two things. Okay, but it's very hard to do that perfectly. But if you were a conniving monopolist, that's what you would do. You would expand as much as possible and serve the market. Or another way is, the market is not a fixed thing. You try to actually expand markets. If the markets are expanding and growing, so then you just your goal is very simple, right? You just try to serve as much as the market, especially if you're a minimum cost player. Yeah, and there is an idea of economies of scale and what is the minimum efficient scale to compete. Now, F, as you can see, is the marginal cost provider here, and that is the minimum scale at which they're able to meet the market price, right? If G is not at minimum scale or they are inefficient for whatever reason, so their costs are greater than the price, and sooner or later they have to exit the market. Okay. So the idea is that you want to be the lowest cost player, but you want to charge the highest price, which is the market clearing price. And sometimes the price is affected by the differentiations as seen by your customers and so on, right? So if you're a Ferrari, you can charge a very high price because the customers see your car as a highly differentiated product, right? But hey, what if you can somehow be a differentiated product and also operate at a very high scale, right? Like for example, an iPhone, Apple iPhone. So everybody wants it and they're willing to pay a high premium, and the market is very, very large, right? So that's an idea of a mass luxury, right? So and other, in the B2B segment, Microsoft is one of such a player of a mass luxury. Well, we don't call it luxury in the B2B segment, but in a B2C segment, another example is Tesla, where you can you're the efficient player, but then electric vehicles are a new segment considered luxury, and you can where people pay a premium in terms of the price. So the efficiencies come from two sides, right? One is called a supply side and the other is demand side. So the one of the classic ideas of efficiency is economies of scale. So you put on a fixed cost, okay, and then the idea is that fixed costs allow you to have lower and lower variable costs. So the idea is that if you can sell beyond a period, a given number of units, you make up your fixed costs, and then everything else is the incremental contribution is all profits, right? So that idea is called economies of scale. So you have an operating leverage and you get there. Another source of this thing is called learnings or experience curves. That is, as you learn, you become better. So the same thing, the widget that you are producing, let's say 5 years back, and the same widget you're producing today, you're much more efficient in doing that. So you have learned your way along. Therefore, even though I have the same dollars invested or the same people invested, the same people are being more efficient in doing the same thing, right? So that's the other dimension of efficiency on the supply side. Similarly, you can have economies of scope. You can say, for example, in the electric vehicle market, the same battery technology or the low level batteries and some of the manufacturing aspects can be also applied to the grid, in other words, as energy storage, or to electric vehicles as vehicle batteries, right? So that's an example of economies of scope. Similarly, like infrastructure as a service in our cloud can be offered to different segments of the market, and you get economies of scope across various industries, right? So that's the idea, and each industry gets its own customized offering, right? So these are all supply side economies that players can take advantage of. And on the demand side, branding is one classic example, but ultimately it is, if you think of it as ultimately a customer relationship you have. When you have a mass market, you can't go and have each and every customer relationship. So the idea is the brand is that proxy for that customer relationship. In a business to business context, each individual relationship, whether through a sales or other form, is the quality of the customer relationship and the trust that the customer reposes in you is the value that is ultimately from a demand side, because then the customer will be willing to buy more from you, right? So that gives you a demand side economies of scale, so that your incremental cost of getting that incremental transaction, that cost of sale reduces over time, right? So that you get an economies of scale there, the demand side. Similarly, as you have network effects, that is, as the size of a customer base grows and your customers talk to each other and they tell good things about you, which is called a net promoter score, or there's a viral adoption of your products, or for whatever reason there are switching costs, the customer cannot easily leave you and go to some other provider. All of this can lead to another dimension of demand side efficiency. And fundamentally, differentiation is a form of demand side efficiency. Okay, so these are all the sort of semi-qualitative, quantitative things that are done in terms of the how of getting there. But all of this ultimately translates to finance, where it's like, hey, given all this capital, how do you convert to sales? And from sales, how do you convert to profits? And then, hey, what is your incremental investment you needed for your working and fixed capital? And then what is your incremental return on capital compared to your costs of capital? And if so, then, hey, allocate and sort of plow this back into the business, right? So typically, the ideal business would have been actually a trading business where I didn't have to put in much of capital, right? And, I buy low, sell high, right? So I buy low, sell high, which means I didn't have much capital. And then essentially my return capital is infinite, right? So whatever profits I get, right? Even if I can get a minuscule profit, if I can keep doing this on an ongoing basis, I can make a lot of money. But unfortunately, there are only so many opportunities for you to do that. And just because you open a low cost trading account doesn't make you a Warren Buffett in terms of picking stocks, or just because you pick up a tennis racket does not make you a Roger Federer, right? You've got to put in the effort either in terms of learning or in terms of making factories or whatever, right? Depending upon what you want to do. So in real markets, right, if you want to actually scale up this whole thing, you may get a bit lucky here and there. So trading business are very, far and few between. So you have to therefore actually invest capital into assets, right? So that's where the idea of companies and corporate entity is actually an engine for making that investment. And since there is an issue of trust, right? So the money people who are giving the money, don't have the time or effort they can put to track you, how they give the money to a trusted agent, in this case, Satya or Amy, who then invest the money on their behalf. And then every 3 months, we come around and tell them, hey, what happened to the investment and how did we do, right? And we have an entire organization. So each one of us is actually an agent on behalf of the shareholder, right? If we slack, we are not serving our shareholders, right? So this is a basic idea. You have capital that comes in. Theoretically, this is called capital liabilities that the company has towards the sources of capital. And the source of capital can be either debt capital, which is called a fixed income. You're giving them fixed returns, whereas and then the residual, but they have a higher stake in the company. That is in the sense that if the company gets into trouble, they can get control of the company and the equity shareholders can get wiped out, right? So they have a higher seniority on the capital stack, okay? But they are getting a fixed return because they take less risk compared to the residual shareholders which are there, right? So those are called the equity shareholders, and that's the two sides of the capital stack. And then that capital, think of it as dollars or money that comes in, and those dollars or money gets invested in assets. Those assets can be long-term or fixed assets, or short-term or working capital assets, right? So that's the idea, right? From capital, you're going to assets, right? So that's the idea. Sometimes it's called capital formation, or you can think of this as the investment process, right? So the idea of investment and the purpose of investment is that earlier, if you did not do this investment, your variable cost would have been high. And then because you put your money into this investment, right, your variable cost is low, and therefore you become more and more efficient player, right? Say, hey, if you want to crank out some ice cream or lemonade and so on, right? If you have a small machine that makes you ice cream or this juice, you become far more efficient, and therefore you can actually capture a lot more of the market than an inefficient player. Remember that A, B, C, D, E, F, G, H in terms of the players. The marginal efficiency player or the player who's inefficient G will sooner or later get pushed out of the market, right? And the market will be captured by the efficient players. That's the theory of the market. But the way this plays out is that for every sale, for every dollar of sales you have to subtract out variable cost. And then after you have subtracted out the variable cost, you can think of that as a cost of goods sold. You get a gross contribution, or sometimes it's called a contribution margin. And that contribution margin ultimately can pay off your fixed cost. And then you can get pure profits after that, right? So that's one way of looking at it. But so when you look at an income statement every time, therefore you look at, hey, what is my sale? What is my cost of goods sold? And what is the gross margin that I make? Sometimes there's a slight difference between gross profit and contribution profits. Okay, but at a very simplistic level, you can think of them as roughly the same, right? And but you can take that contribution margin, and if the contribution margin is high or your gross profit margin is high, it means that sooner or later you can quickly pay off your capital that you have put in place, and then and then you can say, hey, how many years of gross profit do I need to pay off my fixed capital? And then if this whole asset can last a longer period of time, therefore I will make many more years of this thing, and then you can look what my total return on capital is. Okay, and this idea is called operating leverage. So once you have paid off, got to this break-even point, you have paid off your fixed cost, and beyond that, it's all pure profits. Okay. And this idea is also called leverage because it's a superlinear effect due to fixed investment. So your the profits then become pure profits after that, right? In some sense, so the contribution margin then directly go into your bottom line. You don't need to allocate more to your fixed cost. So ultimately, you can package all of your assets and liabilities on a sheet, and this is called a balance sheet. On the left side, you have your assets, short term on the top, long term at the bottom. So that's the working capital and the fixed capital. And the right side, you put debt on the top and equity on the bottom, right? So that's the basic idea. And the reason it's called a balance sheet is that the numbers should balance on both sides. So the dollars I put into my capital should balance the liabilities that I owe to my debt and equity holders, right? And sometimes the equity is also called a book equity. And later when we look at measures like price to book and so on, we will see that. Okay, so there's also a notion in financial terms that, hey, the market is actually valuing you a lot more than your book. In other words, the market is giving you an intangible value that, hey, you're probably holding some long-term thing which is not actually captured on your accounting book. And then that extra value on the other side is balanced by a liability, which you can think of as the net market equity, right? And that ratio of the total value to the book equity is called price to book. Okay, so this is another way of thinking about it, right? So especially the intangibles are not there in software and other sort of businesses where your price to book is more than one. So the step 2 is once you have the capital in place, your goal is to then convert this fixed and working capital to sales, because just having your stuff as capital doesn't make sense, right? If you remember that if you have this orange juice machine, that itself is not valuable. What you need is the orange juice, and then by the way, orange juice itself is not valuable until you get dollars, right? So your goal is to get to dollars of revenue, right? So sales or revenue, and sometimes that is called a turnover, or asset is turning, and you get sales or revenue, and you turn this crank over and over again, right? That's why it's called turnover. And you want to be efficient about this, right? How do I take my factory and get more sales? How do I take my inventory and then how do I get more sales out of it, etc. Right? And or if I have a sales force, how do I use my sales force efficiently to get this, right? So then once I have sales, you convert that to profits. You can have different measures of profits at different levels. Hey, what's my gross profits after my immediately important costs? And then if I have additional somewhat discretionary costs, such as, sort of the corporate staff, others, engineers and stuff like that, research and development and sales and marketing and so on, that if you subtract out, you get to operating profit, and that thing is called operating margin. And then there are some variants of this. You can have operating margin or earnings before interest and taxes. That's one thing. But post-tax operating margin is, which is after you have actually subtracted a tax rate. So it's not EBIT, but profit after tax, PAT. Right. And then there are some other variants called EBITDA. If you have a very asset intensive industry, you want to actually look at your earnings before some other factors like depreciation, amortization. This is more to analyze the behavior of that, because the other factors could be volatile, right? But on the long run, you want to clean up and see what all these factors are. But if you want to study the business more carefully, some of these measures are useful. So there is EBIT, EBITDA, profit after tax. And then if you take out a small allocation to working capital and you subtract that out, that is called cash flows from operations, CFOA. And then if you further look at, so allocate some amount to the fixed capital, or capital investments or capex, and then you subtract that out, and then the rest is called free cash flow. And then again, there are two variants of free cash flow. One is called free cash flow to firm, that is both the debt and equity holders, and after you subtract out interest and so on, then the remaining stuff is called free cash flow to equity. Ultimately, as an equity holder, you are interested in free cash flow to equity, because that and only that can ultimately pay you the dividend and be potentially reinvested and so on. Okay. So if you look at this cycle that we started off with, remember that's very simple cycle, right? You take capital, go through two stages, the DuPont two stages, asset turnover and profitability, and get to income. Okay, that's the efficiency of your business, or the return on capital portion. And then once you've created an efficient engine, you can reallocate the capital or reinvest that capital. That's a form of compounding. Remember, that's the E part, right? That's the one that actually gives you the exponential crank in your growth of capital. And then if you have some excess, if you're unable to find these engines of growth enough, which can consume these extra capital that you're finding, that excess capital, you can return it back to the shareholders. There are two ways to return capital back to shareholders. You can give them as dividends, which is just cash payments, or you can buy back your shares, because then the same sort of profits are then divided by smaller number of shares, because ultimately you look at what is your free cash flow per share and how that grows, right? So so the buyback is also considered a form of return of capital to shareholders. Okay. So there are some tax benefits of doing one or the other, but either is possible. So all of these are called capital allocation decisions. So fundamentally, I think we have emphasized this multiple times. Growth is a function of efficiency, and all these factors, right? Whether it's a margin or turnover, all of these will give you the license to grow. And then how much money you put back into the business, that actually bounds your growth rate. In fact, your maximum growth rate without needing excess capital is the reinvestment rate times return on capital, right? So there are some businesses where you actually have a good engine for you have an efficient engine, but you're not able to crank that engine a lot more times, right? So in other words, you have a very high return on capital, but you are unable to find enough projects to reinvest that capital. So you have to give back some of the money. So that reinvestment rate is therefore not 100%. It can be less than 100%, right? If the reinvestment rate is greater than 100%, it means that you're actually borrowing money or bringing money from external capital providers, right? And if your engine is actually inefficient, you're actually burning capital, right? If you're another way of looking at it, if your return on capital is less than the risk or the charge that the market is expecting you to meet, therefore you're burning capital, right? So then you got to fix your engine. Either you first got to get your act in order in terms of efficiency, do more with less, all the good stuff, and be more efficient and right size your business, all of that, and be lean and mean, and therefore you're ready to grow, right? So that's one aspect. Or you're probably constrained by the market. The market itself is not spending. Maybe earlier you were over earning because you were earning because of the nominal growth as well as which included an inflation component. So suddenly, as the Fed is targeting inflation, it is also compressing that nominal growth, the nominal dollars you're making in terms of sales. So if you look at your balance sheet and your P&L, suddenly your revenue starts coming down, but the revenue is coming down because the Fed is actually clamping down on the customers and they're spending less, right? But net, all of that means is that you have to ensure that your operating model is well sized and lean to meet that market. So ultimately, if you put all this together, you can think of the journey from a customer value to free cash flows as like follows, right? You come up with a great customer value proposition, you have offerings in the market, and that's the product market fit that you make. And then you get your early sales or early orders, and then you repeat this over and over again. The customers are well engaged, and then that leads to monetization, and the customer gives you orders. You have a Mac deal or you have ACR and all those things in the cloud, and you have a backlog, and this can be called a GMV or gross market value, depends on the kinds of business you're dealing with. In our business, we have ACR, Mac, and all that stuff. Okay, and these orders then ultimately has to convert. So Mac is an example of backlog of future orders, and then converts that as your consumed revenue. That's the ACR. Then that gets to sales, and then subtract out your COGS from that, cost of goods sold. And you get a gross profit. Subtract out the SG&A or sales, general and administrative investments. Each of this you can think of as an investment. COGS is an investment. SG&A is an investment, and at every stage, after all these investments, you get to put the various levels of profits. And then you have to incrementally invest in your working capital. That's called the delta working capital investment. You get to cash flow from operations, and you put a delta cash capex investment. You get a free cash flow to firm, and then you pay off your debt or interest, and then ultimately get to free cash flow to equity. Right. So that's the basic idea. So I think fundamentally the C-suite operates in the following sense. If you have higher return, in other words, that's a measure of efficiency, you have the license to grow. And in fact, if you have a higher return, the first question the investors ask, why are you not growing? Why are you not able to find more source of growth? Okay. Okay, and the reason they ask you is because the valuation of your company actually depends a lot on that, right? So if you look at this picture on the left here, if I have a high return on invested capital, the horizontal thing here, so I have 24% return on invested capital, and I grow at a earnings growth rate of 10%, my P by E, which is one example of a valuation, can be quite high. Whereas if I have a low investor rate of return on invested capital like 4%, and my nominal is cost of capital is 8%, which is lower than, so my return ROIC is lower than my cost of capital. And then if I try to grow faster, right, my P by E starts at 7 and then goes down, right? If you notice here, as I grow more, my P by E actually goes down, and the market itself will not even allow me to grow at 8 or 10%, right? So the board will be asked lots of questions, why are you growing, right? So the basic idea is if you have low return capital, you've got to stop growing and fix the return capital. And then once you have return on capital greater than your cost of capital, it's called weighted average cost of capital, WACC, then you grow. In fact, if you have a return on capital that is much greater than weighted average cost of capital, you should grow, right, as much as possible, given and maintain that return on capital. Okay, and these are, remember, the ROCE, ROIC, these are just slight variants of this. You have ROEs in some context, right? So your ideal case here is you want to have high return on capital and high growth, right? And that combination is this green bar here, and you can look at it, some other valuation metric here. In this case, it's a price to book. So here again, it tells the same story. If you have a much higher return on capital, then your return on book, which is the price to book ratio, is much higher, right? Whereas if you have return on capital lower than your cost of capital, you should stop growing, right? So these are one important decisions that are made in boardrooms and in the executive suite on what to invest in, what to grow, how much to grow, and measure your return on capital. So Amy keeps everyone in track and saying, hey, this is your return on capital, why are you growing? Just cut your investment, right? So the C-suite is very focused on how much capital to allocate, and if a business is not shaping up, they should allocate less capital, right? Because that's what the shareholders would expect them to. So, and these things have a nonlinear effect. Since ROC, remember, is in the exponent, which means that the valuation ratios, P by E and all of that, tends to grow in a nonlinear or a superlinear manner, right? So if your operating, say, profit ratio goes up in a consistent basis, and the market expects it to be there for much longer, right? Your whatever the valuation ratio, whether it's price to sales or whatever, right? A Coca-Cola, for example, the operating margin is much higher than some other cola which does not have the same brand effect, right? So that's why a company which is much more efficient, much from a return perspective, has a much higher valuation on the stock market, right? Whether it's measured by price to sales or price to earnings or price to book or whatever is your favorite metric. Okay, so just again summarizing the same thing we've looked at from a different view, right? Remember, this whole thing is cyclical, right? You have capital, you deploy it in the business as assets, and then that assets have to give you sales. Sales give you gross profits. Gross profit gives you operating profit, and then from operating profit you get net profit after you subtract out other stuff, right? Depreciation, amortization. These, think of them as investment in incremental in incremental capital. But another view to that is these are called accounting profits. Another view is called a cash flow cycle, where you actually laser focus on where is my cash going and how's it moving around. So you have capital raise, you get a bunch of cash into your balance sheet, and then you take that cash, put it into assets, and those assets then churn out revenue. Again, you look at your cash revenue. It's not the booked revenue. You figure out when they actually owe the money for that revenue. And sometimes if you're not actually booked your revenue, it's sometimes called deferred revenue. Okay, it shows up on the one part of the working capital pages. And then end of the day, you have to look at your cash revenue, how that cash revenue converts to cash operating profits. And then what is the incremental working capital investment and the incremental fixed capital investment you make. So you get to cash flow from operations after you subtract out short-term or working capital incremental. And then if you further subtract out incremental fixed investments, you get to free cash flows. And again, you subtract out debt, you get from free cash flow to firm to free cash flow to equity, and you come back, right? So all of these terms that we've used, okay, these buzzwords should no longer be mysterious to you. If required, you can pause these videos or go back and look at it, but it's fairly simple. These are fairly straightforward concepts, and so on, right? So the cycle is what you have to look at. And then when you're trying to diagnose a business, you have to say, hey, where are things going wrong? Where is the business inefficient? Is it inefficient in the way it converts from capital to sales, or that part is efficient and then it's not converting from sales to operating profits very well, right? So you can then diagnose where is the source of inefficiency and go fix that. Okay, and then of course you can look at various other sources, and then if I'm inefficient, you want to first fix it, otherwise you'll be plowing in a lot of your capital into that, right? So then you have a mindset of how do you allocate your capital and how do you get efficiency out of your capital. Okay, so now if you were to look at all of this and look at valuations and so on, I'm not going to go through all parts of this chart over here. I put two types of companies, right? Why are tech companies valued more than say auto companies, right? An auto company tends to be very capital hungry, right? You need a lot of capital over time, right? And if you also be inefficient or less efficient in terms of how you convert from that capital to sales and from sales to profits, you look at what is your overall return on capital, right? And one part measure of that is your operating margin is low, right? And then out of that operating margin, if you have to do a lot of reinvestment, you have to do a lot more R&D, you have to do a lot more, you have to build a lot more factories, you have to put a lot in working capital, and then you go. So it has a sort of high demand for capital, right? It's called capital intensive, and it also you have to keep reinvesting more and more capital into that, right? So your conversion from capital to sales, from sales to profits, and again, reinvestment rates, all of these are high, right? So then if you then put it all together and say, hey, what is my return on capital? Is it at least meeting my working capital costs? If not, then you have a problem, right? So then you should either shut down your business or become more efficient. Right. Whereas a tech company which is well run tends to have very high operating margin. As you can see, the operating margin are far more than almost 2 to 3 times or even more than saying just if you look at the numbers for Microsoft, this was numbers from 2019, you have an operating margin of 35%, right? Which is a fantastic operating margin to speak. I mean, this is after and your gross margins are close to 65-70%, right? Which is again fantastic gross margins. And then you are able to reinvest that. You have more and more revenue growth. You have large new addressable markets where you can put this, and then you're generating sustained free cash flows and operating press. And you're efficient, right? And that's the whole idea, right? So if you're capital efficient and you're finding new markets and you can deploy this, that's why the market loves these tech companies and they're given very high valuations. Okay, and one important idea is that people sometimes confuse, hey, market is going up and down and all of that stuff in terms of secondary markets. But in general, if you look on a very long time frame, ultimately, if you look at the growth rate of your of price, you can break that into what is the growth rate in the price to earnings ratio, and then what is the growth rate in earnings itself, right? On the long run, if you look at most the price to earnings or the valuation ratios, they tend to oscillate. Sometimes it's very high, sometimes it's low. They tend to operate in a band, right? So if you tend to buy a security towards a high end, you have a little bit higher risk. But if you tend to buy it towards lower end, you have lesser risk and so on and so forth, right? So that's the timing of when you want to buy. But then on the long run, the most of the change in price can be explained by the change in earnings, right? And the change in the price to earnings ratio, especially if you go for 30, 40, 50 years and so on, right? If a company lasts that long, is smaller, right? So in general, one way to think about is the valuation price matters linearly. It matters. So in terms of when you overpay or underpay, but ultimately compounding of profits or compounding of cash flows matters exponentially. Because if you look at the formula P times e to the power of ROCT, that P itself, right? In the P is if you take dollars and then ultimately you buy based on numbers of shares. Okay, the number of shares you're able to get is ultimately P, right? And that number is based on what is the price you paid for it. Whereas the ROC times T is the one that is going to carry your day over the long run. So ultimately, you want to buy companies that are efficient, that are showing high return on capital, but then they have the ability to reinvest that over a longer period of time, right? So that's why that would be the bluest of the blue chips. Okay, so let's take a final, bring it all together and say, hey, what is the report card for Microsoft? Right? So this is a snapshot I took from a site called ROIC.ai. And as the name sounds, it actually looks at return on invested capital and tracks this over several years. So if you can see, the numbers are from 2007 to 2022. I took the snapshot in late January here, and this shows a stock price. It goes ups and down and so on, right? If you look at the very long term, you can even barely see the wiggles in the past, right? Whereas when you look at the last 1 or 2 years, the wiggles seem to be bigger, right, optically. But over the past, you don't even see the wiggles, right? So that's the idea, right? So you have volatility in the past, but that volatility tends to matter less. So if you were to do random sampling, any time you bought Microsoft, there would have been a reasonable decision in the long run. Right. So, if you look at, if I have highlighted some pieces from this thing, it's a very nice summary you can look at. If you look at the important numbers I talked about, the return on equity of Microsoft is amazing here, like 36.8, which is considered, compare this to the interest rate that you get on your bank, right, which is 5% or less, right? And the return on invested capital, which is another way to look at it, is 24.3, right? And there are some adjustments people make because sometimes the operating income includes the investments Microsoft makes in its employees and so on. Sometimes you can capitalize that. The net of it is the ROIC somewhat gets lower. There are some adjustments, so you can recalculate the ROIC based on adjusted numbers. Okay, but fundamentally, these ROIC numbers are terrific, right? Just to speak, and the reason Microsoft is a blue chip is because it has very high returns invested capital. And if you look at this green bar that is shown here, this has been sustained for a very, very long period of time, right? And if you look at the ROIC numbers, Microsoft has sustained high return on invested capital rate or high returns on equity year after year, right? There have been some periods where it's been a bit lower and so on, but when it's been investing cycle, but then beyond that, especially the last 5-6 years, where I've done some of these calculations, it's been terrific. Okay, and if you look at the growth rate, the free cash flow has also been growing, which means that Microsoft and Satya and Amy have been able to reinvest this capital into, say, the cloud, and then now AI, OpenAI, all that stuff, right? So it was going to drive stuff. So if you look at componentry of this, right? So you take the capital and then convert to sales, and then you have operating margin and so on, right? So if you notice that your ROIC is somewhat lower than your operating margin, so operating margin is 40%, right? Your gross margin is 60-70%, right? So whereas the return on capital is lower, which means that your conversion from your capital to sales, is less than 1, and etc. Right. So those are some of the considerations you want to see, right? But at the end of the day, Microsoft is a $200 billion revenue company. On a very high base, we are making a very high operating margin and a fairly high net margin, right? So we should be proud of ourselves, and then, but at the same time, they can't be complacent. We have to look into the future. The market is assigning a high valuation multiple. In fact, if you look at this 1.39, it means that your P by E compared to the market P by E, you're getting a premium, almost 40% higher premium. So you have to deliver, essentially high return on capital, more than what the market return on capital is, right? So which it's an indication that Microsoft is delivering high returns capitals as shown here. Okay, with that, let me summarize and close this out. So fundamentally, the picture is very simple. You've got to be efficient. And then if you're efficient, you grow. And efficiency can be decomposed in how you convert from your capital to sales to income. It is not just from your sales to income. Okay, so that's the idea of efficiency. And that efficiency becomes the driver of growth. Your growth rate is ultimately bounded based on what's your efficiency or return on capital. Right. So I think that's where people get confused. Sometimes they think they can grow, but in general, but it's important that unless you're efficient, you should not grow. And your rate of growth is upper bounded with your return on capital. I mean, unless you want to keep raising a lot more capital. Then next is that you should try to grow. In fact, if you're efficient but you can't grow, you still get a lower multiple in the stock market. If you're efficient and you can find new target addressable markets and you can grow, and you can find projects where you can invest this in, like we are trying to invest in OpenAI and all this good stuff. So then you can expect more and more cash flows into the future, right? So in other words, you have a future, your terminal value can be high, and therefore your valuation can be high. Right, and then you have to reduce your risk. There are various kinds of risks you can reduce. Of course, one is the most important is the operating risk and where you invest and what do you get the returns, and then how you play in the market and how you manage your costs. Right. So if you're lean and mean in terms of cost, that itself actually reduces a lot of risk. And then if you are operating at large scale, you can get all the cycles of the economies of scale on the supply side, economies of scale on the demand side. All of that will drive your efficiency and actually lower risk at the same time, right? So that's the overall summary. With that, thank you. I have actually a series of LinkedIn articles I wrote a couple of years back. I also write regular posts from time to time. But I think this two-faced Roman god Janus is a good exemplar of risk and return and how to balance it. And the difference between these two actually matters exponentially. The economic value creation goes into the exponent of your thing, and that's why it's a nonlinear effect on how to grow. With that, let me pause the recording, and I want to thank you for your time.